Good morning. My name is Martin Frenette. I head business development for the Notz Stucki group. We hold a semi-annual conference on the markets, and as a keynote speaker, we're very glad to have Anatole Kaletsky with us this morning. He doesn't really need much of an introduction. He's been speaking at our events for quite some time, as well as the markets for the better part of the last, we won't say how long, Anatole, but his views are very sought after, as 2016 has sort of pretty much started as 2015 has left off. We thought it would be very topical for him to come and share his views on the markets as well as a few points. The presentation will be focused mainly on how zero interest rates have affected both the economy in the developed and emerging world and the markets. And probably before we even launch on the latest turmoil, it would be a good idea to get your views on how that has evolved over the last 8 years now. Anatole.
Well, I think zero interest rates, they've obviously been very controversial. I think especially in the European banking industry at the moment, where it's not just zero interest rates, but negative interest rates here in Switzerland that are making it very difficult for banks to make any profits and obviously for their depositors to generate any returns. But given the circumstances that existed in 2009, they were an absolutely essential part of the solution to it. And the real significance, I think, of what's happened in the last few months with the Fed beginning to move back towards normalization is that the US has really pioneered the response to the crisis, both in the initial development of zero interest rates and ultimately in the move out of it. If it turns out that the US is now growing in a sustainable way and can begin to tolerate somewhat higher interest rates, which I believe will be the case, and much more importantly, which is what the Fed believes, then I think that will act as a model for the rest of the world, which is following the same policies of the US, but with a lag of 2 years in the case of Britain, 3 years in the case of Japan, maybe 5 years in the case of Europe. And what we are now seeing evolve in the American financial markets is what we can expect in the rest. Now, the good news for that about that is that American stock prices have grown by about double what European and Japanese stock prices have done in the last 5 years in dollar terms. The bad news is that since the Fed started moving rates a month ago, we have seen a very negative reaction in markets all over the world. So I think we're at a very, very critical point now. If it turns out that US asset prices can withstand this shift towards positive interest rates, which has started in the US, that will be a very, very favorable indicator for asset prices all over the world. And I think we can expect a period of catching up while non-American assets start to appreciate relative to American assets. If it turns out that even the US, with its rapid growth over the last, particularly in employment over the last few years, can't withstand this very, very modest tightening of monetary policy, then of course it's very bad news for the whole of the world.